The reality of who can afford a home in 2026 is a bit uncomfortable, because when you actually do the math and look at how much salary it takes to afford a $25,000, $50,000, $100,000, or $200,000 house, most Americans find it very difficult. Today, we are going to explore how much house you can afford based on these prices. So this is an updated version of a housing video I made about 3 years ago, and the environment has changed dramatically. We now have mortgage rates at 6%, and the median home price is around $400,000. In 2026, this calculation has become harder, so let us break it down for each specific house. But before that, we have to talk about a common rule of thumb when buying a home, which is the 28-36 rule. This is the classic rule that banks use, and they will tell you it is all about measuring affordability. But in reality, I think it is more about seeing how much you actually qualify to borrow. This rule states that to qualify for a mortgage, your mortgage payment, including taxes and insurance, should be 28% of your gross monthly income. Therefore, if your household earns $100,000 a year, it means your monthly pre-tax pay is about $8,333. If you multiply that by 28%, you should get $2,333 per month. That is the monthly mortgage amount lenders are willing to provide to you. Now, the reason you should be cautious about this rule is that it does not take into account maintenance costs, HOA fees, utilities, or other home ownership expenses. It just tells the bank whether they are likely to get their loan back. The 36 part of this rule refers to your mortgage payment plus all your other debts like car loans, student loans, or credit card debt. All of these added together with the mortgage must be less than 36% of your gross income to get approved. Now, I want to clarify one thing here. Just because your mortgage application is approved does not mean the house is affordable in your situation. Mortgage lenders do not really care if you have enough extra money to save for retirement. They only care if they can collect the loan. So we can use the 28 and 36 rule as a guideline, but I do not think it is the ultimate standard for affordability. I think a better framework is that you should try to keep your total housing costs, including mortgage, taxes, insurance, and HOA fees within 30% of your net income. That is your after-tax income. Or in other words, the money that actually hits your bank account. In my opinion, using net income is much better than using gross income, because gross income can be an illusion. You might think your household earns $150,000 a year, but in reality, you only take home $100,000, and your budget should be based on what you actually receive. However, 30% of net income is just a goal, not a guarantee. In some markets, especially in coastal areas, even reaching the 30% net income standard requires a level of household income that most people do not have. This is where this video gets a little uncomfortable. Before exploring the salaries needed for different types of homes, here is my honest take. When it comes to affordability, you need to calculate your own budget. That is it. Rules of thumb can be references, but they are not that important for your personal monthly expenses. You should look at your net income and calculate what is reasonable for you to spend on mortgage, utilities, property taxes, and maintenance. One person's net income will be worlds apart from another person's. Because if someone maxes out their 401k at $23,500, their take-home pay will be much lower. In this case, their salaries might be identical, but their take-home income will be completely different. Many online calculators make assumptions that may or may not be correct, and some affordability rules are not realistic or are a bit outdated. For example, the 3033 rule for buying a house states, you should have a 30% down payment and not buy a house more than 3 times your annual income. This is exactly the rule I discussed in my video 3 years ago, but the problem is many people in the comments said it is rare to have 30% cash for a down payment. Now, I actually agree, especially if you live in a high cost of living area. Saving a 30% down payment at the start is almost impossible unless you save for 10 years. And finding a house priced at less than 3 times your annual income is also almost impossible. So what I ultimately hope you take away from this video is that if you calculate these numbers yourself, you will feel most comfortable with the actual cost of the home. The best way to show the actual cost of a house is to run the numbers. So let us look at a $250,000 house first and see how much you might spend each month. This way you can understand which numbers to use in your calculations. Alright, starting with a $250,000 house, let us assume a 20% down payment and a 6% mortgage rate. First, you need at least $50,000 in cash for the down payment. Now, if you do not have that much, you could consider a 10% down payment, which is $25,000. But be careful, any down payment less than 20% requires you to pay PMI, which is private mortgage insurance. This insurance is paid entirely by you, but it protects the lender from loss. If you default, you personally get no benefit from it, and until you reach 20% equity, it is just an extra monthly expense that causes stress. Okay, let us assume you put 20% down. This means you need a $200,000 loan at 6% for 30 years. That works out to a monthly principal and interest payment of about $1,199, which is $1,200. Then if you add property taxes and insurance depending on where you live, your total monthly cost might be between $1,500 and $1,700. To be conservative, let us take the middle value of $1,600 per month. And this means, based on the 28% affordability rule, your monthly gross income should be around $5,714, or your annual gross income would be roughly $68,500. But please remember, this is just the bank's rule. So according to my 30% net income rule, you actually need to earn more than this. Assuming your take-home pay is about 75% of your total salary, you would need about $5,333 in monthly net income. This translates to a pre-tax salary of about $85,000 per year. So the bank might tell you that you can manage with $68,500. But to truly live, save, invest, and not worry about the mortgage, you probably need nearly $85,000 in pre-tax salary to comfortably afford a $250,000 house. So if you are making your own budget, I suggest using the $1,500 to $1,700 monthly figure in your estimates. If you have any HOA fees or PMI, you must add those in as well. Alright, that is the $250,000 house. Now let us double it and look at a $500,000 house. In America, a $500,000 house is about $100,000 higher than the median home price as of early 2026. In most areas, this price will find you a nice place to live. For example, like this house in Raleigh, North Carolina. It is really nice. A $500,000 house with 4 bedrooms and 3 bathrooms at about 2,000 square feet. We assume 20% down and a 6% mortgage rate, which means you need at least $100,000 in cash. That is the down payment. This is a milestone many families have not reached since the median American savings is only about $8,000. Young people who buy $500,000 houses usually have family support, inheritance, or are high-earning dual-income couples. After a 20% down payment, you need a $400,000 loan. At a 6% rate, the monthly payment is about $2,400. Total expenses after taxes and fees are about $2,800 to $3,000. Let us use $3,000 as the baseline. If you are in a high-tax area like California or New Jersey, please use the upper limit for planning. According to the bank's 28% gross income rule, you need a monthly gross income of about $10,714. Or a pre-tax annual salary of about $128,500. Now, according to my 30% net income rule, assuming take-home pay is 75% of your gross salary, you need about $10,000 in monthly net income. $10,000 in monthly net income is equivalent to an annual pre-tax gross income of about $160,000. So I feel this is already very crazy. If you want to keep expenses within the 30% net income rule, a $500,000 house requires $10,000 in monthly net income. Many people cannot do this on their own. So this is most likely a total household income. Now, having 2 incomes under one roof might still be a struggle for many dual-income families, because both of you must earn at least $80,000 a year and you still have to be very careful with other expenses. Alright, that was the $500,000 house. But now let us talk about the $1 million house, because the $1 million price point is an aspirational one, especially if you live in coastal areas. In popular cities like Seattle, New York, San Francisco, or Miami, $1 million home prices are common. Deeply analyzing the cost of buying in these high-premium markets is very worthwhile. $1 million can buy a mansion in a low-cost of living area, but in many of the cities I just mentioned, $1 million only buys a regular home. And if you live in San Francisco like me, $1 million only buys 838 square feet in the form of a condo. Okay, a 20% down payment means you need $200,000 in cash before applying for a mortgage. You need an $800,000 loan at 6% for 30 years. This works out to a monthly principal and interest payment of about $4,796. At this price point, if you add property taxes and insurance, your total monthly cost is between $5,800 and $6,300. So today we will use $6,000 per month as our calculation base. This is where it gets a bit uncomfortable. According to data from the National Association of Home Builders, only about 6.9 million American households have enough income to afford a $1 million house, and there are 134 million households in total. So we are talking about the top 5% of the population here. When we talk about affordability, according to the bank's 28% gross income rule, you need about $257,000 a year. Now, according to my 30% net income rule, again, assuming take-home pay is 75%, you need about $20,000 in monthly net income. This is equivalent to a household pre-tax gross income of about $320,000 a year. This is based on an actual tax rate of 25%. If your actual tax rate is higher, then your total household income should also be higher, maybe $350,000 or $360,000. Buying a property at this price usually means applying for a jumbo loan. Since the conventional loan limit in 2026 is set at about $832,000, jumbo loans require higher credit scores and significant cash reserves to manage risk, and the interest rate will be slightly higher too. So the threshold for qualifying will be slightly higher than your standard mortgage. Then again, if we use $6,000 a month as your budget, can you really afford it? For example, if you and your partner take home $12,000 a month together, this might be too tight. It is only truly affordable when you earn $15,000 a month, supplemented by quarterly bonuses that increase the average monthly income by $2,000 to $5,000. Next, let us look at the $2 million level, which involves only a very small minority of households. Some people are buying these homes. Contrary to what social media wants you to believe, only about 2% of American households have enough income to afford a house in this price range. So let us do the math. For a 20% down payment, you need about $400,000 in cash, which is crazy. And you must take out a $1.6 million loan. This means your principal and interest payment alone is $9,593 every month. That is almost $10,000 a month once you add in property taxes, insurance, and even higher maintenance costs. Or HOA fees. Your monthly spending will easily reach $12,000 to $13,000. According to the 28% rule, you need a household income of $514,000 a year. And if calculated according to my personal 30% net income rule, you need about $40,000 in monthly take-home pay. This means it would translate to $700,000 in pre-tax income per year to be more comfortable with a tax rate of 32%, which is higher. Now, because your income has increased accordingly. So not many families or individuals earn $700,000 a year. You probably need two incomes from high-paying jobs, like both working in finance or being doctors or lawyers. Or perhaps one person is a VP at a tech company, and the other person also has a good income elsewhere. At this level, math is no longer just about budgeting. While budgeting is still important, what is more critical is whether you are in the right tax bracket. This is a sad truth that a $2 million house is very hard to reach today. Even in San Francisco, where 73% of homes are valued at $1 million or more, less than 42% of households have an income of $200,000 or more. So even in one of the most expensive markets in the country, this affordability gap is huge. And at the $2 million price point, it only gets harder. Okay, so what is the conclusion here? A $250,000 house means you need about $85,000 in annual income. If using the 30% net income rule, a $500,000 house needs about $160,000 a year. A $1 million house needs $320,000 a year. And in my opinion, buying a $2 million house probably needs about $700,000 a year to really feel comfortable. Most Americans simply do not reach these numbers. This is the brutal mathematical reality hidden behind housing costs in 2026. The huge gap between people's income and the actual price of homes is the fundamental reason for the current housing crisis. But what I hope you truly get from this video is definitely not general fear or worry. I just hope you will go and do the math yourself. Never let a bank unilaterally decide your home buying affordability. Only by precisely controlling your finances can you sleep soundly after buying a home. If you want to further improve your personal financial strength, please watch my video on how to quickly increase your net worth in 2026. By the way, did you like that transition? If you liked the transition, please leave a comment to let me know. I sincerely hope you are satisfied with today's content. Thank you for watching, and I will see you in the next episode.